Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast, where we cover the week's top news stories about the market, the economy, and your portfolios, so you can be better informed in making decisions about your money. And with us today, we have a special guest, Chris Ahrens. Welcome, Chris.
Thanks for having me.
Chris is a member of our investment committee. He's a CFA, a Chartered Financial Analyst, which is the gold standard in portfolio management. And Aaron Tuttle, who is the Chief Investment Officer, is at home today because his wife, Lindsay, is delivering their second baby. So thanks for coming in and filling in.
Big shoes to fill, but happy to be here.
Yeah, we're wishing him good luck with the new baby for sure. Well, today we're going to cover some information that'll be a little different from the past, in that we've been talking about the risk of inflation to portfolios. But there's also the matter of deflation, and that's one of the things that you're going to cover today. So when we're looking at our themes of things that we talk about, this is going to impact kind of our thinking about how we view the markets, pricing of equities, the movement of interest rates, and how deflation it can be defined as either good or bad. So I think the first good news is that the COVID cases are declining. In fact, we've seen a 77 or 78% decline in new cases over the last 7 weeks, which is pretty remarkable. So much so that yesterday, Texas has reopened everything fully, and they have removed the mask mandate. So I know that some are wondering whether that was done too soon, but we'll certainly see. But I think it's certainly a good sign for us, for the economy.
Great sign for the economy, good sign for markets, moving towards herd immunity. It's all good news.
So let's talk about deflation.
Yeah, absolutely. We usually talk about inflation, but now it's kind of good we can give the argument for deflation. And it really begins with last year with COVID. We saw lockdowns in the economy, and prices were declining from that. Well, we're getting ready for the economy to reopen, and now we're starting to see inflation expectations to pick up somewhere between 2 and 4%.
That's a pretty big increase, at least relative to recent trends, wouldn't you say?
It is. And of course, if we're making the deflationary argument, that they would say that's going to be transient, and that will be very short-lived.
But, you've talked about, and we were discussing earlier, about the difference between good deflation and bad deflation. So let's talk about the good part.
So
what
we
does
would
that
consider good deflation. It always usually begins with technology and innovation. We have a few examples looking back and where we are now and kind of looking forward. And the main example we have for looking back is Netflix. People often forget how quickly they've come up, but they were doing DVDs for most of 2000 and didn't start streaming until 2007.
It wasn't that long ago, if you think about it.
So we're talking about 12 years ago. We're still getting our little queues on Netflix to send us mail-in DVDs sent to us snail mail.
Wow.
Pretty amazing how we forget, it's become such a big part of our life that you forget that that's happening that quickly.
I mean, think about it. So 13 years ago, we were driving to the store to go pick up our DVD to watch a movie, where today it's on your phone. It's on your TV.
You'd go to the store, you'd pay $3, $4 for a rental, or $15, $20 to buy the DVD if you wanted to. And now you're streaming Netflix for $10 to $15 a month, and you have the whole library catalog that Netflix has given you.
So where it used to be you pay to buy one DVD that now you own it forever, you pay that same price and you get an unlimited number of DVDs.
Exactly. So we would consider that part of good deflation, that happened quickly, hard to even notice. But next, we really see we're looking at autonomous driving and electric vehicles.
Yes.
So your car used to be internal combustion engine. Well, you're trying to get rid of that and really turn your entire car into a computer. So we know what's happened over computers the last 10 years. They've gotten faster, a lot more data storage, and prices stayed about the same. You often reference that old Radio Shack ad.
Right, the old Radio Shack ad where you could buy a computer with 20 megabytes, and now you can get 20 gigabytes, however that much. I don't even know how much that is, but I know it's a big number.
Exactly.
And it's really in a short period of time, and you're paying almost the same price as you did 20 years ago. It's
exactly.
amazing.
And the same expectations are there for the car to the consumer of bringing down prices. But On the flip side of that, about 3% of our workforce is involved in trucking and delivery services.
That's a pretty big number.
So over time, obviously, it won't be the full 3%, but some of that workforce is going to get displaced as Tesla, Waymo, some of these other SPACs you're seeing on CNBC that are in the electric vehicle space and in the battery space trying to get a longer range battery. Once that happens, they can really start, unfortunately, displacing some of those workers, but it brings down the cost to businesses. No longer have those wages of those employees. You can work your computers a lot longer, especially if they're able to get the range in those batteries. All of that bringing down prices for both the end consumer and the business.
It could bring a new meaning to work remote because you could just stay in your car and let your car take you everywhere you want while you're working. But that'll be a long-term trend. In other words, this is something that we know is going to happen over time. And in fact, the Biden administration is pushing towards all these Green New Deal initiatives like electric cars, things that don't destroy the environment and so on. So when we're looking at that as an equity, for example, a stock, let's say something like Tesla, what does that mean in terms of how we categorize that relative to something that's been around for a long time, like
so some
GE?
of those names we find difficult to invest in for obvious reasons, and we'll get into more later how we would consider those long duration equities since cash flows are negative. They're looking at paying out and being profitable far into the future.
So long duration equity. So that'll be another topic that we'll talk about a little bit later today. But let's continue on with this.
One final example of innovation coming in the supply chain. So when you think of maybe a brick and mortar, maybe a Dollar General, they're limited by their shelf space. And they need to make sure they're only putting products on the shelf that they can sell to you. And there's a cost involved to make sure that's supplied and that they're only putting things that are going to get sold. Well, online retail doesn't have that same issue. They now can have millions of products instead of thousands, and quickly with their algorithms, they know exactly what you're searching for. They can make sure they put the products that you need right in front of you. And end of the day, cheaper product for you.
So even with today's technology, we see companies like Amazon, which have already had an impact on the lowering of the cost of goods, whereas maybe something like Tesla will have a more longer term effect because you need infrastructure, you need a place to have trucks and cars plug into to get their battery recharged. But don't you think that eventually we'll have even battery life being much more efficient the same way that the chip has been, right? So now you can store an enormous amount of information on a little bitty chip that you couldn't do 20 years ago.
And they're still shipping these things long distance, so there's shipping costs. That last mile to get it to you, there's only so much that the driver of an Amazon car, you can only go to so many houses in a day. So over time, they're looking at, well, you order your pair of shoes online, and it ships several hundred miles to get to you, even longer. Well, what if 3D printing's in a spot where they can have that locally, cheap enough, you put in your order, it gets printed locally, and you have a drone, who knows, coming to your house to deliver that thing. Prices can come down significantly.
Things are going to look a lot different for my grandchildren, I can see already with all of this.
Yeah, and we would really be considering all that good inflation, prices coming down. But central banks don't necessarily like that. They see prices coming down, and they get worried.
So why is that?
So debt can become harder to pay back. You may be making less money. Interest payments are still the same. Debt becomes harder to pay. Default risk rises in the economy.
I see.
They also, rates are already low because you're having deflation. Well, the central bank likes to be able to reduce rates to be stimulative to the economy. That takes away from one of their tools. If rates are already low, they can't really reduce rates much lower.
Right.
And it takes away one of their tools.
So it sounds like inflation is what the Fed is trying to generate because that's what actually makes that policy work to whatever they're trying to do.
So while all that good deflation is happening, the Federal Reserve is making sure the money supply is high to help combat some of that.
So what are the things that we would be concerned about, and how would we know that there's what we look at as bad deflation?
So that gets to bad deflation. So the good deflation, production was really high. Technology is helping us produce more than the money supply is growing. When we start seeing bad deflation, the monetary deflation, you see at some point technology will start to see diminishing returns. When that happens and the money supply is still growing, you're going to start seeing some increase in the CPI. So if you start seeing the increase in inflation, the Federal Reserve, central banks don't have much of a choice. They need to try to slow that down. They need to increase rates, hold back some of the money supply. That's the monetary deflation, the money supply getting pulled back to fight some of this, the interest rates increase from the diminishing returns.
So in that case, the concern would be if there's a diminishing return on the continual deflation that's happening because of technology improvements.
Exactly. And
But
so
that's probably a long ways away, when you think,
Yes.
because we haven't even really hit our strides with artificial intelligence, for example, and who knows what type of deflationary effect that's going to happen. But certainly we understand that should we slow that the good deflationary effect, that's when we would have a problem with this current monetary policy. Is that what you're saying?
yes. So the Fed is going to try to pull back some of the money supply. That's going to increase rates. Borrowing costs increase as well to companies. They're no longer able to fund some projects that are no longer considered profitable as these rates are rising, and you really get a credit crunch, and it leads to the recession.
How do we monitor that, though?
We're constantly watching, the money supply and production, and currently, I don't think we're in any real risk of the money supply slowing.
I think I saw that slide on my TV on the news. Looks like we're going to have a huge $1.9 trillion stimulus package.
Yep.
Right. So that's putting more money to the economy. So
Treasury does not have $1.9 trillion. They're gonna.
Yeah. Where does that money come from?
Yeah, they're going to have to issue some treasuries. And if the Fed wants to, maintain rates where they're within their policy, they're going to have to buy some of that debt, increasing the money supply. And that's just the $1.9 trillion, which the Senate is working on now. They have to make a couple adjustments, make sure they have all 50 votes to get it through. There are some concerns we see here that 2 House Democrats actually voted no on this. Of course, it didn't matter. They have plenty of votes, but they didn't like that it wasn't quite targeted enough towards maybe people who needed the money.
Right. So it'll be interesting to see what happens in the Senate.
Yes.
In case there might be.
You got to make sure they get the moderates
all it
on
takes
board,
is one really to derail the ability for that to pass the Senate. But likelihood that it's going to pass. I mean, they'll make some type of compromise or change, but they're going to get this thing passed one way or another.
Yes. And then after that, they're talking about $3 trillion infrastructure bill. Don't really know. Hard to predict where the votes will lie on that, or to get some Republican support, how much farther they'll have to drop down from $3 trillion. But anyway, the pumping money is coming, and it's stimulative for stocks.
So I think another thing that's important is that this is not money that just goes one day in as soon as it's approved, right? Either the $1.9 trillion stimulus or the infrastructure spend. This is money that's going to be going in over a staged period of time over the next few years. So wouldn't that lead us to believe that we're going to have an increasing or at least a high money supply for at least the short term or mid-term period? And it's really after that where we might start being more concerned about the money supply.
That's exactly right. And the market sees that too. As we know, the big story of last week is increase in rates.
Yeah, talk about that. That was an interesting thing that happened.
So you can see rates here in August at about, this is the 10-year Treasury. And I'll explain why we're looking at the 10-year Treasury in a moment. But in last August, about 55 basis points. Last week, it hit over 1.5, 1.55. And when that happens, we really need to take a look back at our discounted cash flow model that we've talked about in the past and see kind of how that affects stocks and bring back in those long duration stocks that you talked about.
Yeah, so what we're talking about is when we're talking about discounted cash flows is looking at the expected cash flow profits going forward with a company. If you take all that money back, how would you price a stock today with those future expectations?
That's exactly right. And you can use dividends, but most of the market is using a free cash flow measure, typically free cash flow from equity, which is more of a measure of potential dividends, what a company could pay in dividends, because we know most companies don't pay out as much as they could for various reasons. So you're looking at forecasting future cash flows, what they'll be, and discounting them back. So
when we're looking at that just from a global perspective for our listeners, when interest rates go up and we're looking at that discounted cash flow model, that actually means that the price of what you're looking at is going to be smaller, right? Because you're assuming a higher interest rate that you could earn on that net present value of that future cash flow.
Yes. And while we're looking at the 10-year Treasury, while we can say it's not risk-free, there's interest rate risk, it is thought of as default risk-free, and this is what a lot of analysts use as their risk-free rate. It's really thought of as an opportunity cost, because you can invest here, you can go there, or you can get, as of last week, for a short period of time, you could have bought at 1.55% interest rate on the 10-year Treasury.
The only problem with buying it at 1.55 is that what the expected inflation would be, that you would be losing to inflation. But let's say if we do have deflation.
Mm-hmm. Or there's, of course, people that are matching cash flows and they're okay losing to inflation.
Yeah, let's say pension funds, right? They have a cash payment that they have to make at a certain future period of time. They can match this purchase at 1.5% or 1%, knowing that money is going to be there at that future date.
That's exactly right, and that's why I said earlier that I think there will be some demand if rates start rising between that 1.5 and 2. Of course, it could go higher, but I think there are a bunch of people that will want to start being buyers there.
Well, it just shows how complex the market is, because we may think of it as consumers or individuals thinking, my gosh, how am I going to make any money if I'm only making 1% over the next 20 years, right? Mm-hmm. Where that's not the way every person looks at it, or every investor, right? Because you have these institutional investors that have different types of needs.
Exactly. And we can bring back those long risk equities that we talked about, the high duration equities here. And, just off the top of my head, to think of a few, we're talking about Tesla, Square, Roku, and Shopify. Now, those are companies that, like you said, are not set to really have positive cash flows for a long time into the future.
So let's talk about that term long duration, right? Because we've talked about long duration bonds, and when people think about long duration bonds, is how long am I going to be paid interest for? 1 year, 3 year, 5 year? Well, the longer that term, the longer the duration. Well, now with equities, we're talking about it in a different way. Is when is it that we're going to start receiving profits, and then for how long?
Exactly.
So that's a different type of duration.
And then you're discounting a cash flow 15 years from now to today, and that magnitude of the increase in rates, as you could see, if you priced one, or if you valued one of those stocks earlier in this year, you might use 1% on your risk-free rate. If you did it last week, you could use 1.55. And analysts all disagree. Some people will do that. Others, you sent me something on Monday of First Trust Bank, and he said increase in rates doesn't affect us. We use 2%.
Right, because they were using a 2% model just to be conservative, saying, hey, well, if it does go to 2%, the rates, what would that do to equity pricing?
Right. And so that's why he said we don't have any problem in our models. But that when you do it that way, perfectly fine. A lot of people do that, but you're not truly factoring in the risk-free rate as an opportunity cost, since he's using 2%.
Yeah, that's more of a risk management strategy in terms of how they view the valuation. But if you want to know what your actual opportunity cost is, what is the opportunity of what I could be making on that elsewhere? That's why we look at that 1.5% 10-year Treasury.
And those stocks that I named off the top of my head, that was a joke. Those aren't actually just off the top of my head. Those are the largest holdings in ARKW, a fund that we actually sold last week. We still hold some of it, but we trimmed about 90% of it. We like those holdings long term, but we knew short term with this volatility, it's not necessarily a position we want the amount of exposure that we had.
Yeah, so it's, by the way, this is not a recommendation to buy, sell, or hold. This is simply informational to understand that there's a distinction in the type of securities that are in a portfolio. So we've been, for some time, in a growth mode with equities, because there's been a large increase in the amount of money that's being invested in technology, right? So technology stocks have done very, very well. As a result, value stocks, which are going to be those companies that are already mature and they're measured more by their profitability, their dividends, that they're not investing for future profits 10 years down the road like a technology company. But this interest rate movement may actually change what may be in favor today. Is that what you're saying?
That's right. And I don't want to make it seem like last week rates hit 155 and everyone pulls out their spreadsheets and makes a trade based off of it. People are looking at it, and ironically, you have to look at the shareholder base with who owns ARK, like we did, and several other momentum investors are involved. Well, they actually don't look at discounted cash flows. They're looking at trend lines and all sorts of other moving averages. But they know it's simple enough. It becomes a self-fulfilling prophecy that they know rates are up. These guys have soft hands. They want to get out of the market quickly, move somewhere else. That's really the name of the game for them. And we saw those trades coming, and we wanted to get out before potentially more of those come. So self-fulfilling prophecy in the fact that no one's really looking and saying we need to sell this, but those people know rates up, let's get out of stocks. That's all they need to know. Go ahead, sell and be on.
So, for example, the S&P 500 has underperformed other equity indices, right? The small and mid cap, emerging markets. Is that because they're heavier in the tech, and the tech are the ones that have been influenced negatively by this movement of the interest rates, these long duration equities?
Right. So I'm sorry, I missed the beginning.
So the S&P 500.
It's more of a core holding, so it's good, or a blend. So it's partially growth, partially that value that you spoke about. And certain growth stocks have done well on the year. ARC, for example, is up 20% or something. Our small cap growth positions up over 40%. But certain other growth funds are not all equal. There are some that have really lagged the market. And as you've seen, energy's up over almost 25-30%. That's a very small portion of the S&P 500, but that's 0% of the growth funds.
Right.
So the overweight to energy and financials our underweight to that position has hurt us, but we have been changing some of that up.
But so the idea here is not that we don't see positive returns in these long duration equities over the long term, but when we're managing portfolios, we have to be also aware of the volatility in the interim, right?
Yes.
So a stock may have a 10% average return over 20 years, but there were years where they might have been down 50%. So you have to pay attention to those years, because those are real years where people are in need of taking money out of their portfolios. So that's why we manage that volatility part.
In our trade specifically, we were up over 40% in the trade. At some point you have to say, well, where have we met our goals here with the risk reward that we see? We need to bring some of that off.
Yeah, that's one of the questions that we ask both in the investment committee, as well as when you have clients, let's say, that have concentrated equity positions, equity compensation with their employers. Is that potential for that additional gain worth the risk of the loss? Right. I mean, once you have a gain, how much more gain do you need to achieve? And that's why having targets and discussions and having a process makes sense.
Right. And again, not a recommendation, just talking about what we did in terms of trimming that in qualified strategies, and we still hold some in taxable strategies where after-tax returns matter, and getting hit with a short-term gain, not something we want to do. And that's something we'll talk about at the end when we have our performance up there, because a couple of our taxable strategies have lagged, but significantly outperformed last year and have large gains in growth positions.
When we're talking about lagging, they're lagging other indices other than what it's overweight, which is the S&P. In fact, that they're right even with the S&P for the year. Yeah. So let's talk about
not a whole lot's changed here in our price points and moving averages. The resistance number is still roughly the same at 39.34, and we still see support down below at a technical correction in the 3,500 range.
Are there any things that we are thinking about right now that we may be concerned about with that may change our forecast on those numbers?
So this slide here shows that. This is the near-term relative strength. And this is everything we talked about long-duration equities starting to lag the rest of the market.
Okay.
Like I said, our small cap growth position in the middle there, and you see small caps done the best this year, is still on the high end, but we definitely lost ground in that position last week. The same is true with NASDAQ 100, and you can see the S&P 500 actually being above NASDAQ and large cap growth. And in taxable strategies, those are positions we still hold. 60% short-term gains. It does not make sense to take them.
Right. So it's not that we don't have confidence in the long-term performance of these holdings, but taxes matter, because taxes are a cost to one's portfolio. We want to make sure that we're looking at what is the ultimate amount of money that you get to keep, right? Not what you
Exactly.
make, but what you get to keep. Well, we're out of time today, so thanks for your presentation. That was very informative. I mean, the good deflation and bad deflation is something that is important for us to understand, and we're going to try to continue to monitor that as we look at our economic thesis about how things are going to unfold in the future, since we're in this new day of modern monetary theory, right? But from what I hear you saying, we're probably more likely to have a longer period of that good deflation, just because there's still so much to go, right? I mean, we haven't even really touched on artificial intelligence in terms of what that capacity really has for us going forward.
And we know the Fed's going to keep trying to fight it.
Yeah, and that's why we have on our website, don't fight the Fed, because they're a pretty strong arm. And we need to know how that's going to impact the movement of prices in our portfolios. So if you haven't already subscribed to our YouTube channel, there is a button that our listeners can click on the, I think it's the right bottom half of the screen. Is that right, Jesse? Jesse is our amazing production video producer. And finally, we'd love to hear from you. So we're looking forward to your feedback to our weekly Market Insight broadcast, because we want to make sure that we're meeting the types of things that you want to learn about. And if you have any questions about your portfolio, your financial plan, reach out to us. You can call the number at our screen at 314-924-5100. And one of our lead advisors or service advisors would be happy to speak with you. And if you want to learn more about our firm, we welcome you to go, or encourage you to go and visit our newly revamped website that has some really cool information on it. So thanks again for listening, and we look forward to having you back at our next week's Market Insight broadcast.